Hi everyone, I'm Debbie Roberts, owner and financial advisor at Property Apprentice. Welcome back to the Week in Review. There's a tug of war happening in the headlines this week. On one side, we're being told 2026 is a Goldilocks year, just right for first home buyers. But on the other, the biggest bank in the country's just cut its price forecast, and there's a warning that interest rates could actually rise by mid-year. Who do you believe? Today, we're cutting through the noise. We will look at why buyers are suddenly abandoning the classic doer-upper, the serious insurance signal coming out of Westport, and whether the window of opportunity is closing faster than we thought. So let's get into it. Our topics for this week. Topic number 1 from Good Returns on the 27th of January. Interest rates could be higher by the middle of this year. Second topic for this week in review from One News on the 26th of January, why 2026 is a Goldilocks year for first-time buyers. Topic number 3 from Stuff on the 29th of January, insurer temporarily halts new policies in Westport due to flood risk. Topic number 4 from RBNZ on the 29th of January, biggest bank downgrades house price forecast. And topic number 5 for this week in review from Trade Me on the 29th of January, is this the death of the doer-upper? Why buyers are ditching the DIY dream. So let's start with good returns on the 27th of January. Interest rates could be higher by the middle of this year. ASB and ANZ have aligned with Westpac in predicting that the Reserve Bank, the RBNZ, will be compelled to raise the official cash rate, the OCR, this year rather than next. ASB's forecast a 0.25% hike in December, followed by a further 0.5% increase in the first half of next year. This shift follows data showing CPI inflation reached 3.1% in the last quarter of last year, which was higher than the Reserve Bank New Zealand's expectations, while core inflation rose to 2.8%. ASB senior economist Mark Smith stated that underlying price pressures are unlikely to cool the central bank's 2% target this year. He noted that while the RBNZ expects spare capacity and a contained housing market to lower inflation to between 2.1% and 2.3%, bearing in mind they want to keep inflation between the 1% and 3% bracket, ASB anticipates inflation will remain in the 2.5% to 3% range, driven by businesses intending to raise prices as demand recovers. Smith views the projected hikes as the RBNZ's easing off the accelerator rather than applying the brakes, with the rate expected to reach a neutral level of 3%. ANZ Chief Economist Sharon Zollner observes that having headline inflation outside of the 1% to 3% band would be uncomfortable for the RBNZ, adding that core inflation measures offered no clear sign of a disinflationary trend. Meanwhile, Westpac Chief Economist Kelly Eckhold predicts the OCR could reach 3.75% by the first half of 2028, through up to 6 hikes. He noted that wholesale markets are already pricing in hikes starting mid-year, which has pushed up 2-, 3-, and 5-year fixed interest rates, with floating and shorter-term rates likely to follow suit by mid-year. So I'd like to point out the fact that the OCR does have the biggest impact on the floating and the short-term interest rates, just like how Kelly Eckhold mentioned about the wholesale market pricing affecting the longer-term rates already. And we've seen an increasing trend in the wholesale swap rates since early January. So, yeah, I think there's a high chance that interest rates could increase sooner rather than later, which brings me to the point that it's quite shocking that there's a lot of borrowers who are currently sitting on floating interest rates. That's really unusual. And now is the time to talk to your mortgage advisor to lock in some of those rates before they get any bigger. Otherwise, you are going to be paying more for your mortgage than you need to. Something else to keep in mind is that as interest rates increase, banks are highly likely to increase the test rates that they use to work out how much they're prepared to lend to you. So as interest rates increase, you might be able to borrow less money than you could at the moment. So keep that in mind as when you're making your decision as to whether or not now is a good time to buy. Topic number 2, From One News on the 26th of January, why 2026 is a Goldilocks year for first-home buyers. Market commentators are calling 2026 a Goldilocks year for first-home buyers, driven by falling interest rates, ample inventory, and increased bank willingness to lend on small deposits to those first-home buyers. Data from Cotality, formerly CoreLogic, reveals that first-home buyers achieved a record market share of 28.4% in the December quarter, surpassing mortgaged investors who accounted for 24.6%. Cotality attributed this rise to the utilisation of KiwiSaver and low deposit lending allowances. In December, the Reserve Bank adjusted the LVR settings, that's the loan-to-value ratios, allowing banks to allocate 25% of all new lending each month to owner-occupiers with deposits less than 20%. Consequently, about 12 to 13% of new lending now goes to borrowers with smaller deposits. In November alone, $871 million of the $1.178 billion lent in this category went to first-home buyers. Cotality Chief Property Economist Calvin Davidson observed that for many, mortgage servicing costs are now comparable to or cheaper than rent, narrowing the gap between renting and buying. Glenn McLeod of Link Advisory noted that most first-home buyer clients are purchasing with LVRs above 80%, with KiwiSaver typically funding 10 to 15% of the deposit. He highlighted the value of the Kaianga Ora First Home Loan, which offers interest rates aligning with standard lending, whereas other low deposit loans generally carry a margin of around 0.35%. Campbell Hasty of Hasty Mortgages stated that while the 20% deposit perception persists, banks have more capacity to lend due to the Reserve Bank of New Zealand's policy shift. However, he warned that borrowers with smaller deposits should expect rigorous debt servicing stress tests. He described the current environment as being a Goldilocks moment, featuring good interest rates, high stock availability, and improved job security. Broader market data shows December sales volumes were 19.7% higher than 2024, with total annual sales reaching 90,300 annually. While listing levels remain high historically, they are down 18% year on year. Davidson noted that smaller investors are cautiously re-entering the market due to the lower rates, though weak rents and impending debt-to-income limits remain challenges. Conversely, movers remain quiet, adopting a wait-and-see approach. So on this, I think it's great that we're seeing so many first-home buyers entering the current market because, we've been saying for a while now, this is a really good window of opportunity, being a buyer's market with lots of stock available and bank lending criteria being very friendly, with interest rates currently all below average. So this is a really good time to be a buyer, but that window could be closing. Topic number 3 from Stuff on the 29th of January, insurer temporarily halts new policies in Westport due to flood risk. A major insurance company has halted new home insurance policies in Westport due to the town's high flood risk. A climate policy expert warns that AA Insurance's decision is likely the first of many and is calling for greater transparency from insurers as they withdraw coverage from vulnerable areas. Another expert suggests the move is a deliberate signal to force investment in flood defences, though she warns this could encourage risky doubling down in Westport rather than managed retreat. AA Insurance, which serves 500,000 New Zealand customers, informed Buller District Mayor Chris Russell in late 2025 that it would stop issuing new home and landlord policies for the 7,820. Sorry, oh God, I'm stuffing it up. Let me try that again. AA Insurance, which serves 500,000 New Zealand customers, informed Buller District Mayor Chris Russell in late 2025 that it would stop issuing new home and landlord policies for the 7825 postcode. Existing policies remain active and a transfer policy is in place for property sales, which means that if you sell your property, then the insurance would transfer with that, but you're unlikely to be able to get other insurance to replace it. Mayor Russell noted on the council website that while this isn't ideal, it doesn't signal a total insurance retreat. Westport has faced escalating floods, with a 2021 event leaving over 100 homes uninhabitable. In response, the Resilient Westport project is underway, involving the construction of 17 kilometres of stop banks. West Coast Regional Council CEO Daryl Liu stated that work has already protected over 30 homes, with more protection planned soon. The councils intend to update insurers in February to make the town much more attractive for coverage. AA Insurance stated that the pause is a responsible step due to elevated natural hazard risks, but noted that they would reopen books if exposure drops. However, Belinda Story of Climate Sigma suggested the move pressures local and central government to fund defences, similar to actions taken by AA's parent company Suncorp in Australia. Story cautioned that building stop banks, effectively long, skinny dams, could increase danger by encouraging new builds in high-risk zones. She advocated for transparency and sharing withdrawal data with the Reserve Bank. Victoria University's Jonathan Boston agreed, arguing that transparency is crucial in understanding the severity of climate challenges. He noted that for many areas, relocation will eventually be the only viable option. Meanwhile, Climate Change Minister Simon Watts confirmed that new legislation requiring councils to develop adaptation plans will be passed before the November election, though questions remain about how the significant fiscal costs of adaptation will be shared between central government, councils, and the homeowners themselves. Are you tired of property seminars that just want to sell you a house? We do things differently. Join me at one of our free events called How to Succeed with Property Investing, where we focus entirely on helping you to build the right strategy. As a financial advisor and experienced investor, I'll show you how to navigate the current market with confidence and help to make the right decision. We're live, online, and independent. We don't sell property. Go to propertyapprentice.co.nz to secure your free spot. If you've already joined one of our free events and are ready to join us with our lifetime coaching program, you can also book a no-obligation phone call or meeting with my husband, Paul Roberts, via the website. That's propertyapprentice.co.nz. Topic number 4 for this week in review from RNZ on the 29th of January. Biggest bank downgrades house price forecast. New Zealand's largest bank, the ANZ, has downgraded its house price forecast for 2026, lowering expectations from 5% to just 2%. ANZ economists attributed this adjustment to a lack of market momentum, uncertainty surrounding the upcoming election, specifically the prospect of a capital gains tax, and the likelihood of the official cash rate rising sooner than expected. ANZ has brought forward its forecast for the first OCR hike to December this year, citing stronger than expected growth and inflation. They noted that as rate hikes draw closer, mortgage rates will shift from a tailwind to a headwind. Regionally, the bank observed a clear divergence. Prices in Wellington and Auckland have fallen, while Canterbury, Otago and Southland continue to rise. In contrast, new research from property data firm Cotality indicates rising industry optimism. A survey of real estate and banking professionals found that the majority expect price growth this year, with 14% predicting increases of over 5%. Cotality Head of Research Nick Goodall described the sentiment as improved but grounded. He noted that while supply remains high, demand is returning due to lower interest rates and looser lending restrictions. However, confidence varies significantly by region. Canterbury, the most confident region, with 87% of respondents expecting price rises. Auckland, sentiment has improved, 73% expect growth, but it does remain cautious due to job security and affordability concerns. Wellington continues to lag, with only 63% expecting growth and most predicting underperformance relative to the national trend. Goodall added that while planning reforms and changes to the Resource Management Act offer long-term optimism for housing supply, the immediate impact will be limited. In the short term, The market will continue to be driven by sales volumes, listing levels, and borrowing capacity. So my thoughts on this are that this is an election year. Everything gets a little bit wobbly in election year. And when there's uncertainty, that creates opportunities for those that are willing to do what other people don't do. Like I said before, this is a great window of opportunity for those people that are looking to get their foot on the property ladder or to purchase an investment property. In the current market, you can negotiate on the price because there are still motivated vendors out there looking to sell. And I'm going to touch on that a little bit more in the next article. Topic number 5 from Trade Me on the 29th of January. Is this the death of the doer-upper? Why buyers are ditching the DIY dream? Rising living and building costs are causing the traditional Kiwi dream of the doer-upper to fade, with buyers increasingly favouring turnkey convenience over renovation projects. New research from Trade Me Properties' Summer Buyer and Seller Mindset Survey of 2,200 people reveals that 49% of active buyers are seeking homes that feel new or updated. Specifically, 33% target renovated existing homes and 16% prefer new builds. Trade Me Property spokesperson Casey Wilds noted that only 6% of buyers are now explicitly looking for fixer-uppers, while just 15% are interested in properties in original condition. This shift has created a significant quality gap in the market. Wild pointed out that while demand for move-in ready homes is high, supply is lagging because 50% of homeowners have no plans to renovate, and 53% of those who are renovating intend to stay put. Consequently, 51% of active buyers cite a lack of suitable properties as their primary barrier to purchasing, ranking it higher than finance or interest rate concerns. The survey also debunked the myth of a summer slump. Data shows that properties listed in January received 23% more views than average, with watchlist ads jumping 16%. Wild advised that sellers with unrenovated stock will need to adjust their price expectations or utilise digital staging to help buyers visualise the potential. So where does that leave us? 2026 is clearly shaping up to be a year of distinct winners and potentially some losers. So my thoughts on this last article are, when everyone's looking for something that's fully renovated or, there's a smaller percentage that are looking at new builds now, I suspect that means that there's a huge opportunity there for people, again, that are willing to go against the tide. If you want to do what everyone else does, you're going to keep getting results that everyone else gets. So, if you want to change your financial position and have people wondering in a few years' time, how did you do that? Then you need to start thinking differently. And so in the current market where you can negotiate on the purchase price, especially on properties where there's lower demand, in other words, the properties that need renovation, if you're a first home buyer, you obviously need to avoid the properties that have got structural defects because the bank is going to want to see that you've got the funds available to fix that. But if it's just cosmetic renovations, this is a perfect opportunity for you to not only make your money when you buy the property, but to increase the value by doing some little cosmetic renovations. So you can make your money when you buy, as well as create your own capital growth by doing a few renovations over time while you're living in that property. Okay, so this is a huge opportunity for so many people, and so many people are going to miss out on that, which means that those of you that are listening to this podcast, you're going to be a step ahead of the game. For first home buyers, like I said, these Goldilocks conditions, high stock and eager banks are a massive opportunity, perhaps the best we've seen in years. But not only for first home buyers, these are great conditions for property investors as well, because the harder you negotiate on the purchase price, the better the rental return is going to look. And again, if you add value to property, that's likely to increase the rental return and attract a better quality of tenant as well. As the Westport News and ANZ's downgraded forecast reminds us, the risks are changing. However, I would just like to say, everyone's guesses about what's going to happen with capital growth are just that, they're guesses. There's no guarantees when it comes to capital growth, which is one of the reasons we always say at Property Apprentice, don't rely on things that you can't control. So yeah, just saying. It's no longer just about the purchase price. It's about insurability, renovation costs, and whether interest rates have one last sting in the tail for us by mid-year. The days of just buying a doer-upper and counting on the market to do the heavy lifting are gone. You certainly need a sharper strategy than buying something that's got no value-add potential that you're paying top dollar for. If you're trying to figure out whether or not you should take the easy route or whether you want to take a little bit of a risk and get better results over the long term, don't guess. Join me at one of our free online classes called How to Succeed with Property Investing. These events are all held live and online, so you can ask me as many questions as you want to, and I'll answer as many of them as I can, time permitting. I'm not going to be able to answer individual financial questions because I won't know anything about your financial position. That's something that we do for clients once we know a lot more about them. But this online free event will give you valuable insights and strategies tailored to today's market conditions, regardless of where you live. Whether you're an experienced investor or just getting started, this free session is going to equip you with the key tools and insights to help you make confident, informed decisions. Don't miss out. Register today and take the next step towards achieving your financial success. At the end of the free events, I'll tell you more about how we could help you if you were a client of ours to achieve your goals. So if you're interested in finding out more about how we can help you, go to propertyapprentice.co.nz and register for one of our free events today. If you've already been to one of these events and you want to know more about how we can help you on your journey, book a no-obligation phone call or meeting with my husband, Paul Roberts, through our website, propertyapprentice.co.nz. Thanks for listening. Hey there, want to stay on top of the latest property news and trends? Subscribe to the Property Apprentice podcast for weekly updates that will help you to navigate the market like a pro. We cover everything from insider tips to expert interviews, so you'll always be in the know. And don't forget to ring the bell and hit that subscribe button here on our YouTube channel for even more helpful content to boost your property journey. Check out the link in the description to subscribe to the podcast, and we'll see you in the next episode. Happy investing.